No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. So much excitement this past week, the past couple of weeks actually, in the markets. We've seen some tremendous volatility. Last week we had I think it was the fastest historical drop in the market as far as going into correction territory, which is a drop defined typically as over 10%. So we saw that happen last week, and then the tremendous amount of volatility this week with craziness. I mean, in terms of both ups and downs, ups of over 1,000, downs of 1,000, back and forth, not knowing how this is going to plan out. Right? Everybody's a little nervous. There's a certain amount of anxiety when you see this type of volatility in the markets, and particularly on the downside. We don't mind the upside volatility, of course. It's that downside. So, making sure that you're that you're properly allocated as far as your portfolios. Taking a look at your portfolios to make sure that you have basically. Here's where I see week in, week out. I have new clients that come in. They typically have overweighting in large caps, all right, and which is understandable if you think about the way the advisor networks typically work. Because here's what you see. The longest bull market in history, which basically has to do with the S&P 500 index, the large caps, more so than, in particular, it's actually outpaced small caps in this particular period. What that means basically is that you're going to see then, when you have over the last 10 years a 14% per year average return, you can see where people would start to lean in that direction, right? And avoid things that aren't keeping up. That's one area. Another is actively managed funds. Sometimes people are trying to even beat that, and they're saying, and they're listening to advisors who, maybe truly believe that they can beat the market. That is, these money managers out there. The problem being, of course, that this typically does not work. There may be some unicorns out there, some exceptions to this rule, but as a rule, it doesn't. And the longer time frame you look at, the less likely it is to occur. And even the unicorns can get into trouble there. And sometimes these unicorns that we're thinking, and by unicorn I mean this exceptional money manager that might be out there that can do this. What we also see is that those money managers are ones that you have to have very high net worth to be able to even utilize their services. In other words, you may need $100 million or more to be able to invest with them. This was covered, by the way, I'm going to show you a book here. This was covered in Tony Robbins' book, Money Matters, and he gets into where he's interviewed a lot of the biggest names that you'll find out there in investing. People like Jack Bogle before he passed, Warren Buffett, Sir John Templeton, and some of these that you may not, Charles Schwab, some of these that you may not be as familiar with that have that still manage tremendous amounts of money, and by that I mean like in the trillions. So, when asked though, and when Tony was interviewing these people, and he asked them, "How would you invest?" to a man, they all said, and what he was asking specifically was, if someone doesn't have that $100 million, someone can't sit at the table with you, but it's maybe a family friend or a family member. What would you advise them on, as the smaller investor, on how to invest? And to a man, they all said indexing. And of course, we've talked about Warren Buffett's famous bet where he bet, there was $1 million bet between he and some active managers, and he took over a 10-year period, and he took the S&P 500 index fund, and they did their active management, or they're buying and selling and trying to time the market and do all the different things that active managers do. And what happened, of course, he blew them away with just that index. Now, of course, the downside of the S&P 500 index by itself, it's a great, if you're looking long term, if you're a younger person in your 20s and 30s, let's say, having that as maybe your only investment even, over the long term, you're going to do fine. Okay. However, if you want to shorten up the volatility, because that's the downside, just like we're seeing now, when we see the markets being as volatile, guess what? That's the S&P 500 index for the most part. Now, of course, they've got the Dow Jones, which is also these super companies, right? We've got the NASDAQ, so you got tech in there. If you pay attention to the small caps, the Russell 2000, all of these kind of play a role, but what we're mainly focusing on are those large caps. That's the one you're seeing up at the front. And all of them in certain time frames are going to have, follow this same type of volatility, some to a greater or lesser degree. Sometimes blending certain things together, however, can reduce that volatility. And then there are other strategies, defensive strategies, that can be applied in your investing to help you even further reduce volatility. All right, we used different strategies that can help reduce this volatility while still maintaining the return. And the way that's done is it's measuring the volatility and it's making strategical moves at times to help protect against, in particular, against bear markets. So there are defensive strategies that can be used. In the bond side, this is another area that asset allocation is so key, because if you have the wrong bond funds, in particular at a time like this, all right, and this goes to the money managers again. What do? They typically are in the wrong bond funds because they're trying to get additional yield. In a low interest rate environment, to get that additional yield, they're typically going into either mortgage-backed securities, in other words, long-term securities, which are more interest rate sensitive. So when we see interest rate fluctuations, we can see these bond prices fluctuate quite a bit as well. Now, since it's such a low interest rate environment, and what just happened with the Fed? They just reduced the interest rate, right, the Fed rate, by 0.5 point, even, in between meetings, which is very unusual. And they call it an emergency measure. And what was the impact or the effect of that? Surprisingly, initially, we saw the market bump up about, it was almost a 600 or 700 point reversal in the Dow, from about 300 and some points down to 350 up. And then the next thing you know, it just started tanking, and the day ended up in a really negative place. So it didn't have the desired effect, did it? Will it long term have more effect? Will the Fed reduce rates even further when they meet next month, or later this month rather? Yet to be seen. So these are some things when you're watching what's going on with these interest rates being so low, is understanding how this affects the bond market. We're seeing treasuries at all-time historic lows. For the first time ever, broke a 1% down under like 0.9, and then today, I think it was down like 0.7, 0.73, something like that. Crazy. That's all. So people are taking money out of the market out of fear and putting it in treasuries or in gold or in other things they perceive to be safe, even if it's not making them anything. All right. The key here is to stay disciplined. All right. Not to follow this herd. It's herd mentality. The issue is staying disciplined means making sure you have the right things. So I'm talking about bonds as an example. Look at your portfolio. Do you have mortgage-backed securities, long-duration bonds in there? And if you're not sure how to do that, give my office a call and we can show you how to do that. We can provide even Morningstar reports to that effect. The other is looking for junk bonds. And this is an area where, Allianz chief strategist was just on this morning talking about, in fact, the bond market. And one of the areas that we're getting into is watching with junk bonds. We have a big chunk in there that's right on the edge of investment grade. It's a BBB minus. So this, meaning anything above that, BBB minus to BBB, all the way up to the A's and AAA. This is all your investment grade quality. On the lower end of that, though, on that BBB minus, the lower end of the investment grade, the concern is in these market conditions that gets pushed into the junk bond realm, which is what is less than BBB minus. That concern is higher default rate. That means that, I think it was Will Rogers, an old humorist, that said, I'm more interested in the return of my money than the return on my money. Well, this is one of those areas where being prudent with how you're invested in bonds is to assure that you, in fact, keep your money, that there's not a default that causes you to lose money. This also, when you go into junk bonds or long duration bonds, I want you to think of stocks and bonds together. What we want is what's called a negative correlation. We want them moving this way. That smooths out volatility. When one's up, the other's down, vice versa. So we end up somewhere in the middle as opposed to bigger swings. To get that, we need to stick with investment grade, short and intermediate term bonds or your bond funds. Okay, if you have other than that in your portfolio, this would be a good time to prune your portfolio. And that's what you want to take away. It's mainly, and if you're not sure again how to do those, I'm going to help you out. All right. For the first 10 callers to my office this morning, the number is 615-376-5325. Great time to get an investment analysis done. It's a part of the free retirement income analysis, comprehensive financial plan that we will do for you at no charge. The number is 615 again, 376-5325. The investment analysis is just a part of that, and with that investment analysis, I'll pull Morningstar reports on your current holdings, on your current portfolio, and I'll go over those with you to be able to show you some maybe the hidden risk that are in your current portfolio that are going to add volatility and potentially, you know, at some point, I don't think this is that time, but at some point we're going to go into another bear market. When that occurs, you want to be prepared, you want to be properly positioned, right, to be able to go through that bear market period without it affecting your income. And we're going to be talking about that later today as well, about how to, in fact, as you're approaching retirement or in retirement, how to maintain a stable income throughout your retirement to make sure that you cover and are able to attain and maintain your standard of living, quality of life, no matter how long you live, and then add in, of course, fund money things as well. And we'll get into that. So, again, first 10 callers, 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. We'll look again at all kinds of questions you might have: Social Security, Medicare, tax planning, of course, tax efficient, how to achieve tax efficient income in retirement. How to also, when we're looking at your portfolio, we'll show you ways to be more tax efficient in your investing as well. Because again, right, it's not just what you make, it's what you keep. So if we can keep more by paying less tax, we only want to pay what we're legally required to pay, no more than that, right? And knowing the rules, we can help you with that and these different strategies I'm talking about. We'll also help you with, again, how the smart money invests. We talked to you about safe money strategies, long-term care. We can address those issues if those are concerns for you. Of course, estate planning, if that's another area. In particular with the new Secure Act we've talked about before on the show, there's a lot of different changes there that can affect your estate planning. All new rules for this year that you need to be aware of. So again, that's all part of the plan. 615-376-5325. Be one of the first 10 callers, and when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And this is one that also covers all of these different areas, and we'll get that out to you as well, or we'll provide you a copy of that when you come in. Okay. Some areas that we're going to talk about. So on the markets, again, this volatility is one area of this, right? That's one of the big concerns. So if we look at what's going on in the market, what's creating this volatility, we see a couple of different factors. One being the election, and of course the big one that's on everybody's mind right now is the coronavirus. So Virtue Capital is a company that that I'm going to be doing more with, and we're going to have, in fact, some of their some of their money managers on the show in future shows here. But I wanted to share something from them that okay, we can go ahead and get rid of that slide. We're going to share some things with you, perspective on the coronavirus. All right, so first we're going to take a break, but when we come back, I'm going to delve into this. We're going to talk about approaching retirement, some different strategies, and also some other things that I've been researching with regard to what's going on in the markets, just to try to give you some perspective and, again, help you stay disciplined. But it starts with first making sure we have the right asset allocation models that were invested, like the Smart Money Invest, right? Invested properly, and then staying disciplined to the plan. We'll cover that when we come back. Join us here. We'll be right back on the Retirement Report.